I'm Greg Hunter. Welcome to USAWatchdog.com. You know, I've been following Deutsche Bank. DB is the stock ticker. It's just under $11 a share. They're trying to hold it above $11 a share. They lost that. There's been a lot of news about Deutsche Bank. And why am I focusing on Deutsche Bank? I think it's the Lehman times 10 of the era right now. It's way bigger than Lehman Brothers. Lehman Brothers implosion caused the financial crash of 2008, and Deutsche Bank is eerily following the same pattern. And they failed the stress test most recently. You go back, they have a huge 12 times loss, a huge, massive off the Richter scale loss. Before that, they were put on a watch list. And I called my friend Rob Kirby, who's an expert on derivatives banking. He gets gold by the ton for his clients. He's an analyst. He has KirbyAnalytics.com to ask him what's going on. Rob Kirby, what in the heck is going on with Deutsche Bank? They look like they're either falling over a cliff or being pushed over a cliff. What's going on?
Well, my view about Deutsche Bank's predicament right now, to me, it's eerily similar to the position that Morgan Stanley was in back in 2008-9, when Morgan Stanley's stock price had fallen down to around $5, and it's currently back up to $48. Morgan Stanley, in my view, was recapitalized by the U.S. Treasury, expressly the Exchange Stabilization Fund, and this deal was brokered through the New York Fed trading desk, where they recapitalized Morgan Stanley, who, in my view, in the time frame was critically insolvent, and Morgan Stanley was basically a cadaver on the table that they reanimated. By injecting trillions of dollars of derivatives into them, and it basically reanimated them. The Deutsche Bank situation today, in my view, is more of an expression of infighting between two regulatory regimes. The Deutsche Bank answers to German regulators. Specifically, they answer to a group called BaFin, which is a fiercely independent regulator in Germany that basically started investigating Deutsche Bank in the 2011-2012 timeframe, when allegations had been circulating all over the world that there was rigging of LIBOR, or rigging of interest rates. And that drew the Bundesbank, which is the German central bank, into questioning the then Deutsche Bank chairman. I believe the guy's name was Anshu Jain. And the German Bundesbank felt that Deutsche Bank chairman Jain was being less than honest with them in direct questioning regarding let's just say interest rate rigging and anything that Deutsche Bank might have had to do with it. So the minute the Bundesbank in Germany, the central bank, the minute they have an issue with one of their players in their financial landscape, they call in BaFin, and then BaFin, once you get on the radar of BaFin, my view is that BaFin has been pretty much at the control of Deutsche Bank since probably 2012. And BaFin would have done investigations into more than interest rates, because at the same time and concurrently with allegations of impropriety in the interest rate markets, there was also a lot of allegations flying around about impropriety in the precious metals markets. And we saw basically once BaFin started investigating Deutsche Bank, we saw very quickly in succession, we saw Germany ask for an accounting or an audit of their gold on deposit at the New York Federal Reserve, and the New York Fed basically told them to get stuffed, and you cannot have an accounting of your gold that we hold in trust for you. And then that led to very quickly Germany saying, well, if we can't audit our gold and see it, we'd just like to have it back now, please. And to which the Fed basically told them to get stuffed again. And you see, this is representative, in my view, of friction between German interests and the American interests. The German interests are very aware of the malfeasance that's been conducted by the Anglo-American banking complex to basically rig interest rates and rig precious metals to make the dollar look strong. And of course, the spearhead of that activity on the part of the Anglo-American banking complex is the Exchange Stabilization Fund, which is a secretive arm of the US Treasury that, in my view, holds probably many trillions worth of dark dollars, which are used to basically make the dollar look strong. And that could be any part of rigging interest rates or rigging the metals markets to make metals look unattractive, the dollar more attractive. So in any case, I highlight to you the seeming at odds nature of the German regulatory regime with the American regulatory regime. And we saw that the follow-on from this was that Deutsche Bank, who had been very active in the London gold fix and silver fix, they exited those markets altogether. Then
they were forced to exit the markets. You're saying.
In my view,
you're saying BaFin, their regulator, said, "You're out. You're done playing. You're done with this."
Yeah, that's right. They said, no more metals for you. You're out. That's my view.
And no more rigging LIBOR and no more rigging Forex, and you're out of the rigging game. Is what they,
of course,
right?
Because shortly on the back of that, Greg, we saw Deutsche Bank not only exit the markets, the metals markets, we saw them admit that they had rigged.
Yeah.
And so then there were admissions, and in my view, this is BaFin saying you are going to fess up to what has happened, and you're going to take responsibility. You see, and it's my view that BaFin is really calling the shots at Deutsche Bank, and I think when BaFin, then there was a point, I believe it was in 2015, when Deutsche Bank's offices were raided. And that was in Frankfurt, and a lot of files and information were carted off by German regulators. So they're very aware. They're very aware of how complicit Deutsche Bank has been in the derivatives markets, basically in the interest rate derivative markets, because I've long maintained that the counterparty for much of the many tens of trillions that the big financial institutions have on their books in the interest rate derivatives arena, the counterparty for much of that trade has been the U.S. Treasury, and specifically the Exchange Stabilization Fund. When BaFin did their investigations and found out how deep Deutsche Bank's derivatives trading was connected to basically the U.S. Treasury complex, they freaked out. And they said, you as a German institution, your job in the world is not to sit here and perpetuate the dollar as the world's reserve currency. You're a German financial institution, not a vassal to the Federal Reserve. And
go ahead.
Well, and they forced them out. They just said, you're not doing this anymore.
Well, let's fast forward to now. I mean, it just looks like are they trying to make them go under? I mean, they leaked out that they were on a watch list, the U.S. version of Deutsche Bank. They had this big 12 times variance loss, which you think that BaFin on the other side forced them out, this huge, massive off the Richter scale loss. And then they most recently they failed their stress test. I mean, is the Fed... are they trying to drive Deutsche Bank under?
Well,
because they're really weak.
Greg, I would characterize it this way. I believe, to begin with, no bank has a 12 times VaR loss in a day. So the position that was reported as being 12 times VaR, that allegedly
value at risk.
To me, this had to have been a position that the bank was carrying for some time. And if the bank was carrying this position for some time, BaFin would have been well aware that they were carrying it. And something provoked BaFin to finally say to Deutsche Bank, you are now going to close this position now. And they this 12 times VAR loss supposedly in a day, it reeks of I'm going to say intervention on the part of a regulator who just said, you're getting out of this pool right now. You are closing this position down. We want it shuttered. And so basically it's the German regulator telling Deutsche Bank, you're going to get out of this pool. And then the Americans realizing that Deutsche Bank and how hostile the Germans have become towards the criminal activity of the U.S. monetary complex. They basically said, okay, you're getting out of our pool? Well, we're going to waterboard you first. And we're going to bring public shame upon you. And I think that's
take them under, couldn't they?
Going on.
Couldn't they take them under doing this? I mean, their stock prices now, they hit another all-time low. Last week, on I don't know Thursday or Friday, it was like 10.30 or 10.37, and then it popped back up for the weekend, but still under $11 a share. I mean, that's what happened to Lehman. They were $10-11 a share on a Friday, and they were worth a penny on Monday.
Yeah. Well, yeah.
Are you worried about them going under? Are you worried about them losing control of this, Deutsche Bank?
I think Deutsche Bank could go under, might very well deserve to go under, but will they be permitted to go under? You see, Greg, in my view, there's no doubt whatsoever that Morgan Stanley was insolvent in the 2008-2009 timeframe. Their stock was at $5, and it looked like it was going to zero. But I mean, they pulled all the stops out and papered over the shortcomings at Morgan Stanley. By doing, like in a 6-month period, Morgan Stanley at the time ramped up their OTC swap book by 10 trillion in 6 months. OTC swaps are credit instruments, Greg, and how Morgan Stanley was able to do $10 trillion of credit-sensitive trading in the interbank market is a dog that doesn't hunt, and the fact that their book grew by 10 trillion in a 6-month period tells us that there was non-bank participation or interference. Because any bank, listen, Greg, any bank that would have been doing trade with Morgan Stanley and in credit-sensitive instruments, they would have been fired. Banks, when there's a credit crisis, banks have their trading curtailed with fellow banks. So we know that Morgan Stanley wasn't trading with banks, and yet their book grew by 10 trillion. It's sort of like, Greg, if I play a little game with you, if I say, think of something gray, think of something that's gray, that's really, really heavy, it has a trunk and big floppy ears and a tail. Huh. How many things could that be, Greg? Notice I never said the word elephant.
Yeah.
But there's only one thing it can be.
The fraud.
So when Morgan Stanley, in the time frame that I'm referencing, when Morgan Stanley grows its OTC swap book by 10 trillion in 6 months, there's only one counterparty that's possible, and that's the ESF.
But is the ESF going to rush in and bail out Deutsche Bank? And it looks like they're not going to do that. And it almost looks like they're trying to take them under.
Okay, but I mean,
isn't that what we're facing here with Deutsche Bank? They're not going to be Morgan Stanley. Their stock is at near all-time lows. That ESF is not going to bail them out. They're not playing ball with the Treasury, the Fed Reserve, and the ESF. They're not playing ball with the dollar complex. Are they going to try to take them under? I mean, that's what it looks like to me.
It could be, but just remember that the European Union has an entity that plays a lot like the ESF, and that's Mario Draghi and the European Central Bank. So what Mario Draghi and the ECB are capable of, I would not underestimate. But I mean, what it really comes down to, Greg, is, I mean, if you're asking the question, should Deutsche Bank fail? Yes. But I mean, Deutsche Bank's derivatives book has declined dramatically from its heights. But a lot of American institutions, their derivatives books have shrunk dramatically over the last number of years. And All I'll say is this, Greg. Anybody who points to Deutsche Bank's derivatives book and says that's the cause of their problems, well, you know what? You've got American banking institutions, beginning with Morgan Stanley, the top 5 American banking institutions. You've got Morgan Stanley with a 35 trillion notional book. You've got Bank of America with a 36 or $7 trillion book, and that's been cut in half over the last 4 or 5 years. And then you've got Morgan Guaranty Trust Morgan Chase, JP Morgan Chase. They've got a book that's around 50 trillion. And then you've got Citibank that's over 50 trillion, and then the biggest one of them all is Goldman Sachs, and they're in at 58 or 59 trillion in notional. And if you think the constituents in Deutsche Bank's derivatives book are materially different than the constituents of these American institutions' derivatives books, you'd be sadly mistaken. So they all have the same toxic crap in them.
But here's my question: is this? Isn't this risky? I mean, you wouldn't be running out to be a shareholder in Deutsche Bank just because you think the central banks will continually prop all this Ponzi scheme up. I mean, you brought up a really important thing a while ago, and that is, we've always thought that the money supply in the world is 1 times X or whatever. They're telling us it's X. That's what they say the money supply is, but you're saying it could be 2 or 3 or 4 times X. Can the central banks keep propping this all up? I mean, it just sounds like that you think the central banks can prop this up forever.
Well, no.
Can they?
I've actually argued to the contrary.
Okay.
I've said that this is a game that will ultimately end in tears. But I mean, what we're really seeing here, in my view, is a trade war that's been going on for quite some time. And getting back to this frictional descriptive that I've given, characterizing the relationship between American regulatory interests and German regulatory interests. It was in 2015, Greg, September 2015, that Volkswagen opened a new engine plant in Russia. And that was basically in contravention to American wishes, because America wanted to put Russia at the time, and still does want to put Russia into an economic penalty box. And as the date approached for the opening of the Volkswagen engine plant in Russia, so did the rhetoric between the U.S. Environmental Protection Agency and Volkswagen regarding emissions on their diesel engines.
And they got a huge fine over that.
Sure, but I mean, the engine plant in Russia opened on September 3rd, and then I think it was less than a week later, the charges were actually leveled against Deutsche Bank for, I think, $17 billion regarding the emissions scandal. And I mean, you couldn't have a closer, measure of cause and reaction than this engine plant being opened in Russia, by Volkswagen, and then days later, Volkswagen is subject to, this very, very, very punitive ridiculousness on the part of the U.S. Environmental Protection Agency, saying that Volkswagen cheated. Well, you know what? I'll tell you this, because I've actually dug into this, because I did own up until yesterday, as a matter of fact, I owned a Volkswagen diesel product myself. And I'll tell you, I did a lot of digging into this, and I know that the German diesel engines are regarded by people in the auto industry around the world as the best and the cleanest diesel engines on the planet. So, and they're the most reliable engines. And I'll just tell you this: my view of it is that this was a slap in the face to Volkswagen and to Germany for not siding with the Americans and shutting down trade and shutting down economic opportunities with Russia. So,
and you think it started really with Deutsche Bank and the regulators saying, "All right, okay, kids, out of the pool, no more. You're not doing this. You're not properly."
Absolutely.
You're saying that Deutsche Bank was helping the U.S. What you've said in the past: hide the sausage, all this debt, and prop up the U.S. dollar. That's what you're saying Deutsche Bank was doing. And BaFin, the regulators, said no more.
That's right. That's in my view. In my view, the trail of breadcrumbs, like forensic economics, which is what forensic macroeconomic research, which is what I hang my hat on. To me, the investigation that I've done showed that this is extremely likely the case. And to me, the American and German regulatory and geopolitically have been butting heads now since probably 2011, 2012. And there's been a smoldering trade war going on beneath the surface, certainly since Deutsche Bank ran into problems regarding interest rates, and then the metals, and then it's sort of broken out beyond the borders of Deutsche Bank to involve other German industrial concerns like Volkswagen. To me, these are all connected. You cannot look at what's going on. In my view, Greg, you cannot look at what's going on with Deutsche Bank and keep it separate from what's happened to Volkswagen.
So, are you worried about the system going down with this kind of fighting? I mean, they're not working together to prop things up. That's what you're saying. They're on opposing teams, and they're pulling their support for the dollar, the Germans, which is a big deal, Germany. And so, are you saying are you more worried about the financial system going down now with this kind of infighting?
Well, I mean, Greg, I've long maintained that fiat money has a life cycle. Just like human beings have life cycles, all plants have life cycles, all animals have life cycles. You have birth, you have adolescence, you have, middle age or adulthood, and, then you have old age, and then you have death. Well, by fiat money's very design, it has a life cycle. And most fiat money regimes have a life that, an estimated lifespan of around 40 years. And we've been on we depegged from the dollar, or America depegged from the dollar, depegged from gold, went off the gold standard in August of 1971 when Nixon closed the gold window. So count ahead 40 years. You're at 2011. So at this point, this current fiat money regime has lasted for 47 years. I would tend to bet that this fiat money regime we're currently living in is an extreme old age. And to me, suggesting that this fiat money regime will continue for another 20 years is akin to betting that somebody who's 100 years old is going to live to see 120.
What are you? I know. Well, I want to get into this because gold's going to get just hammered, and my friend Greg Manarino says, "Listen, what I see is they're hammering gold, silver, Bitcoin. I mean, your silver's down around mining. Of course, it popped up a little bit last week, but he said they're just hammered. They want everybody out of that kind of stuff, and they want them into the stock market, into the U.S. dollar. What are your friends? You arrange the buy and sell, mostly the buy, of tonnage of gold for people. What are you seeing on the world market where you're arranging gold by the ton for people? What are your contacts telling you about what's going on right now?
The demand for physical metal has never been higher than it is right now, and I would actually characterize the demand coming out of the Far East as being acute right now.
What does that mean? What are they saying to you?
They can't get enough. They can't. There's not enough physical metal to satisfy the amount of dollars they wish to put to work in obtaining physical metal.
Does that mean people are trying to get out of the dollar? Are your clients trying to shed all their dollars, all their treasury bonds? Are they trying to get away from it?
Let's just say they're trying to exchange dollars for physical metal in extreme amounts. Yes. That is occurring, whether anyone wants to admit it. And despite the paper games and the attacks coming on paper exchanges, like COMEX and even the LBMA, where they pound the living daylights out of the paper price of metals, the demand for physical metal, Greg, is unrelenting, and it's insatiable, and the people that want it cannot get enough.
You said a long time ago that this is going to end when China, I guess, and other people don't get their gold. That when they can't get gold anymore, that's when the whole thing ends. Are we getting close to the point which you predicted a few years ago that said, this is going to end when people stop getting their gold?
Yeah, basically, and then and that's akin to saying, when you're committed to kicking a can down the road, Greg, at some point you run out of road, and we're very close to running out of road. So, and betting, like I say, betting on this fiat money system to continue operating as we've known it for our lives is in my view like betting on somebody. It's like trying to try buying insurance on somebody who's 100 years old. You can't. Nobody will sell it to you. But yet, the powers that be seem very committed to trying to tell us or trying to make us believe that metaphorically, someone who's 100 is going to live to see 120 or 150 for that matter. And it's never happened. So, and it won't here. People don't live that long.
I know you're on the phone with people in Dubai, without disclosing your clients, over in Asia, over in Europe. You're on the phone all the time. What is the one reoccurring theme that you're hearing from your clients and your sources about what's going on right now? What are you hearing?
Well, they talk in terms of when the system collapses, not if, and the constant theme, Greg, is trying to find tangible stuff that will survive a major reset. So that's a common theme, and you know what, Greg? I sound like probably a broken record saying it, but it hasn't changed. It's been this way for quite some time.
Are they getting more panicked right now? Are they at do you see them at a higher pitch? Do they think that they can see the end of the road? Are they getting more and more panicked, more and more desperate for to transfer dollars out into real stuff?
No, Greg. These guys never show signs of panic. They just show signs of more resolve.
Wow. How close do you think we are? How close do you think we are?
I thought we were really close 2-3 years ago, and obviously we're closer now. But like I say, Greg, it's not a matter of if; it's a matter of when.
A lot of folks, they get their spidey senses up, and it just seems like there's a lot more than ever. Whether it's Zero Hedge, even if it's some of the mainstream channels. There's a lot more negative news. Confidence just went over. They just recently, consumer confidence just went down. The GDP just projected to go down. Unemployment is projected to go up. There's just a lot of bad numbers, and everybody is always predicting the fall. This because that was when the great the great crash happened in the Great Depression and before the Great Depression in '29 in the fall, September, October. Is that time frame popping up on the radar of you or your clients? The September, October time frame. A lot of folks like that time frame in general, and I've heard that over and over again over the years.
Yeah, I mean, historically, that's been a time when markets have been subject to large amounts of turmoil. But I look at it more, Greg, from the standpoint, I'm looking at escalating. Like I see this whole event-driven situation between American interests and German interests. I look at it as the decay and the unwinding of, geopolitical agreements, or to think that America and Germany would be at each other's throats over the dollar. If you had suggested such a thing 10 years ago, people would have, in my view anyway, people would have just laughed at you. But to me, we're seeing it in Technicolor now. And 3 and 4 and 5 years ago, countries that were basically taking actions, anti-dollar actions, would have only included probably China, Russia, and a few other smaller Asian players. But now we're starting to see the friction between, it's not just Asian players. Now it's Germany, and And all I'm going to say is, who's next? Is it going to be the whole European Union that is going to drift into that camp of the anti-dollar camp as well? I mean, America's becoming isolated. Even though the dollar, of course, the dollar looks strong because they have dark money in terms of untold trillions of dollars that are housed in entities like the Exchange Stabilization Fund, that they can run interventions in big markets like the foreign exchange market, in the equities markets, to make the U.S. stock markets look like they're stronger than they really are. And they can, because they have this money that's not even acknowledged officially to exist, they can marshal these resources to absolutely annihilate the paper price of precious metal, and make precious metal appear as an unsuitable alternative for diversification purposes, against the dollar. But the world's getting wise to what's really going on. And as the world becomes and gains knowledge of what's really happening, it's just becoming a lot more isolation, or manifesting as more isolation for America and American interests. So, I mean, I see it happening in Technicolor, and I see it happening increasingly in more countries and in more, let's just say, in more jurisdictions that used to be very, very American friendly. So that's the direction we're headed in.
Do your sources worry about this 21 trillion Dr. Mark Skidmore identified at the, we're using government sources, Inspector General resources that they took off the internet. It's a real number, 21 missing trillion dollars at the DOD and Department of Housing and Urban Development. It's a real number. Add that to the 21 trillion that we're already in debt for. Is the world, are your sources saying, wow, I didn't know there was another $21 trillion, we don't know where it is?
Yeah,
are your sources freaking out about that? They think this is real? They're more resolved because of this too. This revelation.
I'll characterize it this way, Greg. People are becoming angry, and pre-interview, I had mentioned to you that I spoke with Dr. Skidmore earlier this week. We were on the phone for quite some time, and a very interesting comment that he made to me. He said, Rob, the first time I talked to you was about 2 years ago. And he said, you came across to me as being somebody who was very angry. And he said, I just want to tell you that I now understand why you're angry, because I feel the same way.
Anybody with two synapses touching together thinks about this 21 trillion, which is a real number. We can't pretend it away. And are terrified about the inflationary, hyperinflationary, this could turn the dollar into confetti if it's realized. Right? Go ahead.
Very, very quickly it could, Greg, because once it becomes accepted by the masses and by countries around the world, once it becomes accepted that this money was fraudulently created and does actually exist. This is literally like, discovering that you have an ammo hut underneath your house, and and it's maybe it would be a good time to put the flamethrower away, because we are sitting on something so explosive here as the recognition and acceptance that this money has been created and exists today. And like I say, I think I've mentioned this to you before, Greg. In the past, I love it how some of these clown people who wear pinstripe suits, who work on Wall Street, who pretend to be analysts and really couldn't analyze anything, beyond their nose. They've often said to me, well, Kirby, you make all these assertions, like where's all the money going to come from for this hyperinflationary event that you've predicted for a long time? And I look at them in disbelief now, because they're such fools. The money already exists. It's just been siloed. And asking where the money's going to come from for hyperinflation, it's sort of like saying, well, where are the nukes going to come from for a nuclear war if one should occur? Well, they're going to come out of their silos. That's where they're stored. But the notion that this money doesn't already exist is, if you actually believe the money doesn't already exist, then you're completely ignorant of the work that Dr. Skidmore has done in collaboration with Catherine Austin Fitts. These people have done their homework using the government's numbers. It's their work.
Okay? Everybody on Wall Street wants you just to pretend it doesn't exist, and we're just going to pretend.
Greg, the amazing
That's a tinfoil hat thing.
When they shone light on this, when Skidmore posted all of his findings on Catherine Austin Fitts' site, Solari.com, all the government did was kill the links. Because to corroborate their assertions, they were linking back to the raw data that they had taken from the government's own numbers. So the government feels that if they kill the links, they can walk away from it and say, oh well, it didn't happen. It doesn't work that way, Greg.
If you're trying to prop up the dollar, and big banks like Deutsche Bank are not going to play with you anymore, a big global bank, and revelations about an extra 21 trillion, an extra 100% more than the 21 trillion we already owe. So we got 42 trillion. If you're trying to prop up the dollar, whether it's Deutsche Bank saying they're not going to play anymore, whether it's revelation of $21 trillion, whether it's a de-dollarization, you got an uphill battle if you're the ESF and the Federal Reserve, don't you?
I believe so. Because, Greg, I will answer the question. If Deutsche Bank is not playing, how long is it going to be before French banks don't want to play, Japanese banks don't want to play, and maybe even British banks don't want to play? Because you know what, these nationalities of banks have also had a hand in what's been going on as well, and it's at least in my view, it's clearly becoming very socially unacceptable to be a part of the club that's propping the dollar up. So there you go.
Rob Kirby, Kirby Analytics, you wrote a great article. Actually, you wrote this article after I called you, and I'm very happy you did that. You put it out for your subscribers. You can go get a subscription to Kirby Analytics for $145 a year. Am I right about that?
Yeah.
Are you going to post this article for public too?
No, you're going to post it on your site for public consumption.
Tell you what, let's drive it back to your site. So you're going to...
No, that's okay, Greg.
No. I'll post a link for it, and we'll put them to Kirby Analytics. So you post it on your site, and I'll drive them right back to your site. I want you to have the traffic. I want you to get the stuff. Also, if you want to be you want to get this kind of analysis on a routine basis, Rob Kirby does have a subscription page for $145 a year. Sounds cheap to me. Anyway, Rob Kirby, KirbyAnalytics.com. There's free stuff on the homepage. And this article will also be on the homepage, and I'll link back from USA Watchdog. Rob Kirby, thanks for writing this. It's a great article. I mean, it's a great piece of analysis on this whole Deutsche Bank thing, waterboarding them. That's funny. It would be funnier if it wasn't so true. But anyway, Rob Kirby of KirbyAnalytics.com. Thanks for joining us today on USAWatchdog.com.
Pleasure being with you, Greg.